Good morning, everyone, and welcome to the June 2026 edition of the Blackfinch 10-Minute Market Forecast. Thank you for joining us. My name is Jordan Kent, Distribution and Sales Exec for Blackfinch Asset Management. My co-host this morning is Blackfinch Assistant Portfolio Manager, Josh Clayton. Now, for those of you joining us for the first time, these sessions are designed to give you a concise overview of some of the key developments shaping global markets, alongside an insight into how we're positioning our portfolios in response. Ultimately, the aim is to help equip you with context and answers your clients may be looking for. Now, if any questions come to mind during the session, feel free to submit them through the Q&A function. Alternatively, I'll be sharing our contact details at the end, so you can reach out to us directly if you wish. Now, before we begin, just a quick reminder that today's content is intended for financial professionals only, and so shouldn't be taken as financial advice. So turning to this morning's agenda, we'll be focusing on three key themes. Firstly, we'll be looking at what remains a waiting game around the ceasefire currently in place between the US, Israel and Iran, and what the potential outcomes could mean for markets. Second, we'll discuss the earnings story emerging from Japan, where companies continue to deliver despite the backdrop of a weaker yen. And finally, we turn our attention to emerging markets and what we believe could be a compelling opportunity set that remains underappreciated by many investors. So with that, we'll get started by handing things over to Josh. Good morning, Josh.
Morning, Jordan, and good morning, everyone. Good to have you with us today. So Jordan's highlighted those three key themes. The first is that a minor update on the conflict, the market implications, and then two of our regional convictions that has helped and continues to help give us some strong performance attribution across both our managed and tailored portfolio services. And as Jordan said, feel free to reach out to either of us off the back of today's content. So whilst markets have welcomed the ceasefire between the US, Israel, and Iran, I do think it's important to recognize that a ceasefire isn't the same thing as a resolution. There are underlying economic pressures that drove both sides to the negotiating table, and these do remain very much in place. Now, I've talked before in these webinars, but it does seem as though Iran's strategy has always been to kind of inflict enough economic pain on the US and the wider global economy to then force concessions before pressure becomes too much at home. Equally, the United States can't afford a prolonged disruption to global energy markets. And we've talked before about the current squeeze on US real incomes and the upcoming midterms that Trump has to contend with. And what that means is, neither side can comfortably sustain the current situation indefinitely. In our view, there are really two likely outcomes. Either one, both parties move towards some form of negotiated settlement, and there's been talks of that somewhat, and that would be supportive for risk assets. Or two, hostilities unfortunately resume, tensions escalate once again, and that really would represent a more challenging environment for both bond and equity markets. And the only thing I think investors are underpricing is Iran's ability to withstand pressure. And I think this chart does help illustrate why. The blue line shows Iranian crude oil production. It's measured in millions of barrels of oil per day. And the red line shows the estimated unplanned production outages. It's worth quickly noting the production figure excludes what's called condensates. These are lighter hydrocarbon liquids produced alongside natural gas. And this just lets us focus on Iran's crude oil here. And if we just look back at history, that there have been periods where Iranian production fell materially without then causing lasting damage to the country's oil infrastructure. I think one example of this is what's called the Joint Comprehensive Plan of Action on the screen. It's also known as, the Iran nuclear deal. It was adopted in 2015. It led to this big, significant recovery in production as a lot of sanctions were eased. And then we move on. There was a sharp decline, 2018, 2020. We had the renewed US sanctions and the disruption caused by the pandemic that pushed production down to near 2 million barrels per day. Yet despite those pressures, despite everything, Iran did continue to operate. They've adapted, and ultimately they rebuild production capacity. And I think that's the takeaway. The assumption that reduced oil output alone is going to force Tehran into immediate concessions hasn't historically proven to be correct. Iran has shown this ability to endure these sanctions and production cuts and economic hardship. We're seeing similar movements in 2026. But yeah, that it doesn't automatically mean you move into capitulation, and that's why we do continue to see this as a waiting game, where both sides are under pressure to find this resolution, but neither side appears ready to concede just yet. And in market terms, I think really investors should probably just focus, spend less time trying to predict the next military headline and focus more on the probability of this negotiated settlement versus the stalemate we're seeing at the moment. Probably a final comment on inflation. The disruption we've seen across energy markets has pushed inflation expectations higher. It's contributed to this, this rise in government bond yields we've seen in recent months. However, unlike the inflation shock of 2022, this is much more supply driven and event specific. I won't use the word transitory. I know central bankers got stung in 2022 and learned the hard way on how dangerous that term can be. But our view does, for the moment, feel like it's energy-led inflation spikes will tend to fade once this supply issue normalizes. And I think that's really important with the next two themes that I'll cover when we come on to it. So on to Japan. This really remains one of the most debated investment regions for most asset allocators in the UK. Whenever I speak with peers across the industry, it's always the same questions about the yen, Japanese government bond yields, what will happen with the equity market. And really, despite all of these concerns, Japan has quietly become one of the strongest performing major markets in the world. Year to date, it's offered returns of nearly 16%. It's comfortably ahead of the S&P 500, despite the yen weakening and 30-year Japanese government bond yields moving above 4%, which is the first time on record. And this chart just helps explain why the blue line shows forward earnings expectations for the S&P 500. And then the red and gray lines show the same measure for Japanese equities in US dollar and then the local currency terms. The key takeaway is that gap between those lines. When measured in yen, actually the corporate earnings growth has been incredibly strong. However, when it's translated back to dollars, much of that strength is hidden by the weaker currency. In reality, it's that weaker currency that's really important for the country. It boosts overseas earnings when converted back into the local currency. It supports the profitability story we're seeing in the region and ultimately shareholder value. And much of that can be traced back to what's known as Abenomics. It came in under former Prime Minister Shinzo Abe, and he had this combination of monetary easing, fiscal stimulus, and structural reforms that helped weaken the yen as it is really improved corporate competitiveness. So we are mindful of the risks surrounding both the currency and the bond markets. We are certainly watching it, but the underlying earnings story very much remains compelling. Combine those corporate reforms with this new pro-growth, newly elected prime minister, and attractive fundamentals on offer. It is some very compelling opportunities for our multi-asset investment portfolios. And if you've been watching our webinars for some time, you'll know emerging markets has been a high conviction position for us in the portfolios. We've seen strong return attribution from both our asset allocation and our fund selection decisions. I thought I'd be a little cheesy with the title and describe the emerging markets as one of the cleaner shirts in the laundry basket here. I'll explain why. But our textbooks would just tell us the asset class should be filled with these weaker governed, higher volatility, lower quality businesses. And while that's somewhat true, it isn't the whole story. And it's precisely why we favor active management in the region. Emerging markets is this vast universe of winners and losers. And that management style allows us to focus on the strongest businesses while avoiding the passengers that sit in the index. And this year's case in point has been some really strong technology companies benefiting from this AI capex splurge. If we go beyond stock selection, many emerging market economies really did learn some valuable lessons in 2022. I've mentioned it already with the inflation shock. While developed markets, central banks were very much behind the curve, many emerging economies actually moved earlier. They've maintained strong policy buffers. They've entered this latest period of geopolitical uncertainty from a position of relative strength. And that resilience is very much helpful. But for the moment, it's all about earnings. That this is what's driving markets, and this is what the two charts are showing. The first highlights some of those opportunities. It shows the earnings revisions across different sectors in emerging markets. And what stands out is the strength in technology and materials. And these sectors are precisely the areas that are benefiting from ongoing investment into artificial intelligence, semiconductor manufacturing, and digital infrastructure. And by contrast, the consumer discretionary has been very inconsistent. It talks to some of the underlying challenges presented by some of the domestic economies. And again, that's another reason why we're preferring active management. Not all parts of this universe are benefiting equally. Careful stock selection really does remain critical. The second chart takes this further. We're looking at the 12-month forward earnings growth expectations across major regions. And whilst earnings expectations in developed markets have begun to moderate, emerging markets continues to compare favorably, still trending higher. And I think importantly, investors aren't paying a premium for that growth. The MSCI Emerging Markets Index trades on around 12.5 times forward earnings. It's broadly in line with long-term averages, but it's still a meaningful discount to the rest of the world, to global equities. And we do like that earnings momentum with attractive valuations. And that's why I say a cleaner shirt out of the bunch to put on if you were to wear it compared to some of the others in the laundry basket. So to summarize, whilst geopolitical tensions are still dominating headlines, we still believe markets are ultimately being driven by earnings at the moment and the AI story. Now, the Middle East, the key question remains on whether this ceasefire is going to evolve into a lasting resolution. Japan, strong earnings, corporate reforms are underpinning the economy despite the noise around the yen. And emerging markets, still one of our highest conviction areas. We like that improving earnings momentum against valuations. But that's everything from me. So Jordan, I'll pass back to you for the wrap up. Thank you, everyone.
Thank you, Josh. And as promised, folks, contact details for us are now on screen. So if you'd like to discuss any of the themes we've covered today, explore topics we haven't had time to touch on, or if you'd like to learn a little more about our managed and tailored portfolio services, please don't hesitate to get in touch. And if you'd like to hear from us a little more, we're actually hosting webinars on the 11th and 16th of June, respectively, where we'll be exploring the hidden risks of portfolio concentration and the shift from off-the-shelf investment solutions towards more tailored approaches, which you can register for either session via the events page at blackfinch.com. But otherwise, that does bring this morning's webinar to a close, which we hope you found useful. Our next 10-minute market forecast will be taking place on the 7th of July at the same time of 8:50 a.m, where we'd be delighted to have you join us again. But from all of us here at Blackfinch, we hope you have a very pleasant day, and we look forward to speaking with you again very soon. Bye for now.